Empires fall over decades, sometimes centuries. History seems to confirm it. Power fades slowly. Territories shrink. Control weakens, one piece at a time. But financial crises don't follow that pattern. They move fast, shockingly fast. A collapse in one part of the system can send waves across the world in days. Banks fail in one country, and markets react in another. Currencies fall thousands of miles away from where the problem began. No armies move, no borders are crossed, and yet the damage spreads further than most wars ever could. Because in a connected financial system, distance no longer protects you. Isolation becomes an illusion. A single failure doesn't stay contained. It travels through debt, through trust, through invisible links that tie economies together. And once that chain reaction begins, stopping becomes almost impossible. So the real question is not why crises happen, but why they spread so fast. To understand that, we need to look at how the system itself was built. At first glance, financial systems look stable. Everything appears structured. Banks hold reserves. Markets follow rules. Governments promise oversight. On the surface, it feels controlled, predictable, secure, but that stability is deceptive, because beneath that order lies something far more fragile. A system not held together by physical strength, but by belief. Trust in banks. Trust in currencies. Trust that tomorrow will function like today. And just as important, speed. Money moves instantly. Information travels even faster. Decisions made in one place ripple outward in seconds. This creates a system that is highly efficient, but also highly sensitive. When trust holds, everything works smoothly. Growth feels natural. Expansion feels endless. But when that trust begins to crack, the system doesn't just weaken. It accelerates the collapse. Fear spreads faster than confidence. And once doubt enters the system, every connection becomes a pathway for contagion. What once made the system powerful now makes it vulnerable. To understand why this happens, we need to look beyond modern markets. We need to go deeper into the structure of interconnected economies that existed long before today, because the speed of collapse was built into the system from the very beginning. Long before digital markets and instant transactions, economies were already connected, not through screens or algorithms, but through routes, relationships, and risk. Trade routes stretched across continents. Caravans carried goods from one region to another. Ships moved wealth across seas, linking distant markets together. At the same time, early credit systems began to form. Merchants borrowed from one another. Promises of future payment traveled alongside physical goods. And debt, quiet, invisible, but powerful, started to move across borders. These connections created something new, an early version of an interconnected economy. But there was one critical difference. Everything moved slowly. Information took weeks, sometimes months to arrive. Goods traveled at the speed of wind, water, and muscle. Decisions were delayed by distance and uncertainty. And because of that, disruption spread gradually. A failed harvest in one region might affect trade. A defaulting merchant might create losses. But the impact unfolded over time. This delay mattered. It gave systems space to respond. Time to adjust. Time to absorb shocks before they became systemic. In many ways, slowness acted as protection, a natural buffer against rapid collapse. But as connections deepened and speed increased, that buffer began to disappear. And with it, the system became something far more powerful and far more dangerous. The problem began when systems became faster, but not necessarily stronger. Efficiency increased. Connections multiplied. But resilience did not keep up. As financial networks expanded, they became more complex. Layers of institutions formed: banks, lenders, markets, clearing systems. And slowly, something changed. These institutions stopped operating independently. They began to rely on each other for liquidity, for stability, for survival. A bank was no longer just managing its own risk. It was connected to the risks of others, through loans, through shared assets, through promises that linked balance sheets together. This created a system that looked stable from the outside, but underneath it was tightly bound. And that tightness came with a cost. Because when one part of the system failed, others didn't just feel the impact, they transmitted it. Losses moved through the network. Stress spread from institution to institution. Confidence began to erode across the entire system. What once would have been an isolated failure now became a chain reaction. And in that moment, risk changed its nature. It was no longer contained. It was shared. And when risk is shared across a tightly connected system, collapse is no longer local. It becomes systemic. And that is where the real mechanism of rapid crises begins to reveal itself. The real shift wasn't just in scale. It was in structure. Financial systems didn't just grow larger. They transformed into networks. In this new structure, distance stopped mattering. Speed replaced geography. Money could move across the world in seconds. Information traveled instantly. Decisions were no longer delayed. They were synchronized. And that changed everything. Because now, markets didn't react one by one. They reacted together. Investors saw the same signals. Institutions responded at the same time. Fear, once local, became global in an instant. This created a powerful effect. Synchronization. Instead of one part of the system adjusting while another remained stable, everything began moving in the same direction at the same time. And when that direction was negative, the consequences were severe. Selling triggered more selling. Losses triggered more losses. Uncertainty fed on itself. What once acted as a buffer, time, delay, distance, was gone. And without those buffers, the system stopped absorbing shocks. It began amplifying them. Small disturbances could now grow rapidly. Contained problems could become global crises. What once slowed crises down now pushes them forward. And to see how this plays out in reality, we need to look at a moment when this system was put under extreme stress. History gives us moments where this hidden structure becomes visible, moments when the system is no longer stable, but exposed. A crisis often begins in a single market, small, contained, sometimes even ignored at first. It might be a drop in asset prices, a wave of loan defaults, a sudden loss of confidence in one sector. At that stage, it doesn't look like a global threat, but beneath the surface, the connections are already in place. Banks are linked through credit. Institutions hold the same assets. Investors watch the same signals. And then the spread begins. Losses in one area force institutions to sell assets elsewhere. Falling prices trigger margin calls. Liquidity starts to disappear. What was once a local problem begins to move through the system, not slowly but in waves. Each reaction triggers another. Each failure exposes new weaknesses. And because everything is connected, there is no clear boundary. The crisis crosses markets, then borders, then entire economies. What started as an isolated failure becomes a systemic event, and the speed is what makes it dangerous. By the time policymakers react, by the time analysts understand the cause, the consequences have already spread across the world. This is a pattern of modern financial crises. They don't grow step by step. They cascade. And once that cascade begins, the system enters a phase that is far more difficult to control. Over time, the system didn't slow down. It expanded. More participants entered the network. More institutions became connected. More capital began moving across borders. And with each step, the structure grew more complex. New financial instruments were created. Derivatives allowed risk to be traded, reshaped, and redistributed. Global capital flows linked distant economies into a single system. Banks were no longer just national. They became global. Their balance sheets stretched across countries. Their risks became international. And layer by layer, the system turned into a dense web, a web where separation was no longer possible. Every connection added efficiency. Transactions became faster. Markets became deeper. Growth accelerated. But there was a hidden cost. Each new layer also increased dependency. Institutions depended on shared liquidity. Markets depended on constant confidence. Entire economies depended on the smooth functioning of this network. And that dependency created fragility. Because in a tightly connected system, disruption doesn't stay isolated. It spreads. The larger the system became, the more sensitive it became to shocks. A small disturbance could now travel further, faster, with greater force. What looked like strength from the outside was, in reality, a system under tension. And as that tension builds, the question is no longer if disruption will happen, but how it will shape the world we live in today. Today, financial systems operate at a speed earlier economies could never imagine. Transactions happen in milliseconds. Algorithms make decisions without human delay. Markets react instantly to new information, sometimes before people even understand it. Everything is faster, more precise, more connected than ever before. But that speed comes at a cost. There is no pause, no natural delay to slow things down, no buffer between cause and effect, no time to fully understand what is happening before the system reacts. And that changes how crises behave. In the past, disruption would move step by step. Today, it doesn't travel. It spreads instantly. A sudden shock, whether in credit, liquidity, or confidence, can trigger reactions across the entire network at once. Markets fall together. Assets are sold simultaneously. Institutions respond in real time to the same pressure. What once took weeks or months now unfolds in hours, sometimes minutes. And in a system moving this fast, containment becomes incredibly difficult because by the time one part of the system tries to stabilize, another part is already reacting. The chain reaction is no longer sequential. It is simultaneous. And when everything moves at once, control becomes an illusion, which leads to a deeper question. If speed and connection make crises more powerful, what does that say about the system we've built? At its core, the issue isn't just financial. It's structural. The system behaves the way it was designed to behave. The same mechanisms that drive growth also shape collapse. Efficiency allows capital to move freely. Connectivity links markets across the world. Speed removes friction from every transaction. These features make the system powerful, but they also make it synchronized. Everything becomes aligned. Responses become uniform. Movements become collective. And under normal conditions, this feels like stability. Markets rise together. Growth spreads quickly. Confidence reinforces itself. But under stress, synchronization changes its role. It stops supporting the system and starts destabilizing it. Because when fear enters a synchronized system, it doesn't spread gradually. It appears everywhere at once. Selling becomes simultaneous. Liquidity disappears across multiple markets at the same time. Confidence doesn't weaken step by step. It drops suddenly. This is a critical shift. The system doesn't break slowly. It shifts all at once, from stability to instability, from growth to contraction, from confidence to panic. And once that shift begins, the system is no longer reacting in parts. It is reacting as a whole, which brings us to the final question. If collapse is built into the structure, what does that mean for the future? Financial crises spread faster than empires collapse because they follow a different logic. Empires are physical. They depend on land, armies, and time. Control expands slowly, and it fades the same way. But financial systems are not physical. They are built on trust, on connection, on speed. And those elements behave differently under pressure. When an empire weakens, the process is gradual. Borders shift. Power declines step by step. But when trust fails in a financial system, the effect is immediate. Connections turn into channels of contagion. Speed turns into acceleration. Confidence turns into panic. And once that shift begins, the system doesn't unwind slowly. It cascades. Failures trigger more failures. Reactions feed into each other. The system moves faster as it breaks. What we are witnessing is not just collapse. It is acceleration, a structure designed for efficiency, becoming a pathway for crisis. And that reveals something deeper. The more connected and faster a system becomes, the more powerful it is in growth. But also, the more sudden its fall can be. If you want to understand how hidden systems shape global stability, this is only the surface. Because the structures we explore today are still evolving, they are becoming faster, more complex, more deeply embedded in everyday life. They influence how money moves, how markets react, how governments respond to pressure, and most importantly, how risk spreads across the world. These systems are not distant or abstract. They shape the prices you see, the opportunities you get, the stability you depend on, and as they continue to evolve, their impact will only grow stronger. So if you want to see what's really driving change beneath the surface, subscribe, because the invisible systems shaping power are still shaping the world today.